people don't know the options and they don't understand, like equity's the sexy one. I want investors, right? But debt is a viable solution. All I'm going to say about debt is keep it in the corporation. It's corporate debt.
So in finance, it's frequently called the weighted average cost of capital, which is an average of your debt financing, your equity financing, and then a discount rate that applies to that. I'm
Again.
T, and it's all about me today.
It's always about tea.
As it should be. Today,
we're talking about a topic that's near and dear to my heart.
No, we're doing that topic later. Bob,
Which topic are we doing
send
first?
you the notes. Why do I send you the notes?
You don't send any notes.
Why do I send an agenda?
You keep saying it's on a laptop.
Why do I make an agenda if nobody reads it?
Because you don't make it.
We're about to have some unhealthy conflict.
What's in it? Invisible ink? I need a lemon.
This episode.
And a candle.
You got to pee on it. This episode is about WACC, Bob. Weighted average cost of capital.
I thought we were doing the website one first.
Debt? No.
Okay. Well, you're speaking my language now, too, as a fundraiser. And go ahead.
Well, because it's the fall, right? We're heading into the year end. A lot of people are talking about fundraising.
And investment opportunities.
Speaking
and
of which,
offsetting taxes.
If you're looking for an investment opportunity, I have a great one.
We have a great one too. But that's not what we're talking about.
Yeah, in all seriousness, the general statement that I love to make, well, two statements. One that we say all the time. You want to hit them with it, Bob?
No.
Best way to raise money?
Nope.
Say
Sell something.
Sell product. Sell a product. Sell your
Sell
first mover
something.
product. Sell something.
That was your number one? Or
No,
number two?
my number one is debt is cheaper than equity. A lot of people.
Have to explain that.
So a lot of people talk about raising money, and the emphasis is on capital for equity, which is a valuable tool for startups, for new products,
for public companies.
Mm-hmm, but especially for startups and new products, you're going to lose a lot.
Potentially.
You're
Potentially.
I'm just talking about straight equity play.
But potentially you're going to lose a lot.
If you're running a straight equity play and you're pre-revenue.
You're talking about the inventor.
The inventor. I mean, I don't know how you're not giving up a lot.
Well, you might be giving up a lot, but if you don't get anywhere, as the stats show that most things aren't that successful, you're not giving up that much because no one's getting paid.
Well, I mean, I guess for me, it's more that you're going to give up a good chunk and you're likely not going to get to revenue depending on what your raise is. So you're going to do 1 or 2 seed rounds, and then you may need to do a Series A, it's become very commonplace to have this cycle of cap raises.
Yeah, but that's on the people that aren't trying to, no offense, they're not trying to build sustainable real businesses because they never look at organic revenue.
Yeah, they're focused on the raise.
They're focused on the raise to keep going to get to the perfect product, which is the third saying we say.
Yeah, perfect is the enemy of the good.
Thank you.
Not to cut you off.
So, no, you can cut me off because you do every episode. So I think you have to go backwards, though, and explain the equity model because you missed one of the models, which I hold near and dear to my soul, which is royalties.
Okay, well, before we get into that.
Okay.
I just want to explain the concept of debt is cheaper than equity. See or no? No?
Oh, you can try it. Go ahead.
I'll try it.
But you have to also give the flip side, the negatives to it.
Well, of course. So
I'll be the negative, you be the positive.
Okay.
There we go. Okay.
So the phrase debt is cheaper than equity relates to the cost of that capital. So in finance, it's frequently called the weighted average cost of capital, which is an average of your debt financing, your equity financing, and then a discount rate that applies to that. We won't get into the technical.
The math on the board?
I would love to get into the math of it, but I won't.
But no one would watch.
No one cares. No one cares like I do. And there's a lot of interpretation there that depends on your model and your assumptions for what discount rate you use. And I would love to get into that, but I'll spare everyone.
That'll be another episode that we won't have a camera on.
But in general, if you think about your interest rate for debt, depending on a lot of different things of what
There's a lot of variables to that.
what you borrow at. But let's say on average, let's say you borrow at 8%, right?
Fixed. Because there are floating rates too.
So let's even say 8 to 10% is where you're at, which I think the high end of that is high. But that's your interest rate of what that debt is going to cost you to service that debt over the lifetime, whether it's a short-term or a long-term obligation. For capital,
equity.
I'm sorry, for equity, the cost of that capital is going to be what you have to return on that, which at a minimum, 20%. If you have very lenient investors.
The tough part is, though, what is the structure on how you're paying back them? Or are you just doing it as a straight
I'm just
dividend?
going as a straight ROI, like the straight amount you have to make back on that capital. So just right off the numbers, you're going 20% versus 8 to 10%. So that
But there
equity,
comes with risks. Higher risk on the debt side.
Well, and the interest and both your discount rate when you do your weighted average cost of capital would reflect the risk of it in the beta of the whole thing.
But I'm saying just straight talk.
Yeah.
If you take debt, that is the first thing that has to be paid back when everything falls apart. That's the risk side. Not because, listen, we all look for success, but we always have to factor in what happens in failure.
Yep.
Okay. So debt, it's the first thing that has to get paid back. They're coming after you for that.
Yep.
Equity side, you all lose money. In a perfect world, you all take your losses on your taxes and walk away. There's probably lawsuits there too.
There's probably ended relationships there as well, most likely.
Right. But there's also legally, they would have to sue you to try to get money back.
Yeah.
And it's really tough to sue a bankrupt company as an equity stakeholder because you're bottom rung. You're one of the last people owed.
Yeah.
Bond or debt holders are paid first.
Well, and it also goes to the point of why we say in a previous statement, the best way to raise money is to sell a product and get to revenue. Because once you are in revenue, any amount of revenue, some form of revenue, debt becomes an option.
Yeah.
Pre-revenue, there are debt options. We're not going to get into them.
And they're very expensive.
And I'm not trying to kick off a fire roll of things here. There are options. But the whole point of saying get to revenue is that, so let me just paint a picture. You have a product. You are trying to get your product to market. You are able to sell a minimally viable product and get revenue, knowing that you are going to have to scale. Let's say you have to buy new equipment, and that equipment is going to be $80,000. There are debt options available and financing available, even if it is a higher interest rate for a company that is in revenue, versus straight equity, where you are now going to have to pay that back when you eventually get to revenue, which could be a year, 2 years, 3 years, never. So that's why our preferred methodology
is royalties.
Well,
sorry,
I wasn't even going to get into that. I was
I
just
know you
saying
weren't.
just
And I'm not
between
gonna get
straight
into
debt
that.
and equity.
But I also think that you're missing the big talk, the big conversation that we have with some of our members, and we definitely have with our clients that we've raised money for, is if you look at the equity side as just getting money, you are doing it wrong.
100%.
Your fundraising is completely wrong because what debt doesn't give you is experts on your side to help build your network, help find your distribution, help perfect your product, build the right team. That's what's supposed to be the positive to equity. I'm not disagreeing with you. The debt's always cheaper if you just look at the number.
Yeah. Well, I mean, and that's why when you do weighted average cost of capital calculations, for most companies, it's a mix, right? You have to do some big expansion. You have to build a new plant. You have to do a $20 million plant. You're going to take some debt out and you're going to issue some equity, and it's going to be a mix of the two, and that'll get you an average.
I would love to see you whiteboard this.
I'd be happy to.
If the whiteboard was clean, I would send you up there.
But it is a different risk profile, like you said, but it also goes to if you are pre-revenue and you have to do multiple raises, every time you do a raise, you have a different valuation.
And you're deluding yourself.
And you are going to wind up with a very messed up cap table. Now, if you are in a business where you expect to be a monster company, it may be a non-issue. Or you may have someone come in and clean up, get rid of the old investors, start fresh, and go. There are options. We are just talking 30,000 feet, high level for new product founders who frequently say, I just need to make a prototype and then I can raise money. Our general feeling, again, industry dependent, product dependent, is if you can get to a minimally viable product and pre-sell product, or, I mean, you definitely need to validate, but pre-sell product, get some sort of alpha product to market where you can be in the revenue, you have more options. And you have, even if you are going to issue equity, you can get more favorable terms because you have a validated product.
But I think, so this showcases the conversations we have every week with some of our members, right? People don't know the options and they don't understand, like, equity's the sexy one. I want investors, right? But debt is a viable solution. All I'm going to say about debt is if you can avoid it, don't take extra loans out on your primary residence. Don't build a company off your HELOC. One is because you're probably breaking the corporate veil.
Yeah. And
you've already commingled personal and company money. If you're looking at debt, keep it in the corporation. It's corporate debt.
And you just brought up an important thing too, which is debt is, as you said, you're signing your name on the dotted line that you're going to pay it back. It is stuff that keeps you up at night. There are people who issue equity and are not kept up at night because it feels less risky. That is not my view on it, but because it is viewed as an investment, and if everyone loses, it can sometimes feel less risky. And I think the result of that is that sometimes you will take out more than you need. Versus with debt, if I have to buy a $60,000 piece of equipment, I'm not going to go, well, let me take out 120 so that I can pay myself $40,000 and I can do this and I can do that. It gives you temporary breathing room to go, oh, I can get bigger office space now, and we can get,
which you don't need.
And we can get 4 showrooms, and we can do all this stuff, and we can be like Google. We can have a cereal breakfast bar, and we can do all this stuff. Much more common and much more likely with equity because you're not going, hey, for every dollar I take out, I have to make $1.40.
But I also think it's a mindset because people, and the ones we meet say, just got to raise money. Their whole business model is to raise money.
Yeah.
The focus isn't on, I need to get a product to market, to test, to make some money, to get feedback and iterate on my product to make it better, or to get a bigger distribution network or a better logistics system or whatever it is. I think if you do the debt route, it's all on you. And, I've built a number of companies on debt because it's all on us, right? We just do it. Right. And if it doesn't work, it's on us too.
I'm looking at debt right now.
Right. You're looking at debt. We've talked about it. But I think it's a different mindset too, that even if you're raising money with equity, that's not your money.
Right. But people feel like, okay, people are willing to give me 140. I only need 60. Great. I can finally give myself a salary.
Yeah. And if that's in the raise and there's a plausible reason, I mean, everybody has to feed themselves.
But if you're finally getting salary and you're 3 years from revenue, I would have serious questions about.
Well, that might be dumb investors.
But that goes back to a point you brought up before, which I hate to give you credit for anything ever. But you brought up a good point, which is early stage companies, especially pre-seed, especially single founder companies. If you are taking on investors, they should be bringing more to the table than money. And that is a hard question to ask, but it is an important one, which is, I'd love to have you as part of the company. What else are you bringing? Are you bringing network?
You don't have to ask them. You should put that in the up front. Like, okay, I'm looking for investors, but here's the weaknesses I have that I need help with.
Yeah.
People don't do that
A lot
enough.
of people don't vet investors. They
also don't vet themselves.
Their main vetting qualifier is, do you have money to invest? And then the other big thing is for seed funding, pre-revenue funding, our view, and I'm stealing this from you, which is something else you said, which I think is true, I have found to be true, is it truly risk capital? Because seed funding will likely be lost before you get to revenue. And if it is not risk capital, true risk capital, and the thing I'm taking from you is a statement you told me, which I think is a good statement. If you say to your investor, you could give this money to me, or you could go to the casino and put it on red, and it doesn't affect your life either way. Now, that doesn't mean that you don't want to make their money back. It doesn't mean that you're willing to lose their money. It just means risk profile-wise, they don't need that money to pay their mortgage, to put their kids through college, to reimburse their retirement account that they depleted to invest in your company. It's a different risk profile, especially if you are pre-revenue.
But the deeper power to that question is it sets the tone for the relationship and the communication you're going to have with one of the key groups of stakeholders your company's ever going to have if you're raising money. It's the investor base. That is a key stakeholder that you should rely on. They should be there when you need help because it's money and their experience and their networks that all come to play to make you more successful.
Yeah. I don't want to get too in the weeds on it.
Well, this isn't the be all and end all the funding.
No, and
this is just something to
We're
consider.
not getting into all the different mechanisms and all the different options. And listen, I'll be honest, there are people more qualified than I am to talk about that. I have lived it and I have had these conversations and I have had offers and I have had good guidance and
Did you point at me on good guidance?
I think I'm just generally pointing. I'm just talking with my hands. But it is something that comes up more and more, and it seems like more conversations we're having with people where they don't even have a understanding of who their customer is. They don't have an understanding of their unique value. And I'll be honest, a lot of the times, they don't even have an understanding of what they would use the funding for. They know they need funding, they know they need a big number, and they know they'd use it for a bunch of things. But if you say to them, walk me through what you'd use it for. You want to raise $2 million. What would you use it for? Put it in buckets.
Yeah. Because that's how people are going to give you the money anyway. No one's giving you all the money you asked for. They put it in tranches.
And if someone does just give you a check,
be worried where it came from.
Yeah. But that's the reason I bring it up is because we are having these conversations, it seems like weekly at this point.
But it's also whoever you're dealing with. You should have these conversations. If they're not bringing up other options, they might not be the best person to be around you. Yeah. Because it's not about the final answer. It's about having the conversation to explore the best avenue for your needs.
Even the conversation of what else, Bob? What else do you have for me today? What else are you invested in? Have you ever invested in another startup or pre-revenue company before? Is most of your investment portfolio real estate? Because that is a extremely different risk profile than startup company investing. What's our plan for when we run out of money for this round? Are you telling them, I'm going to use your 200 to get to here? We're not going to be in the market yet. But at that point, this is the progress we've made. There are some products that are very expensive to develop. You may need to raise money. If you can raise debt, or if you can raise partial debt and partial equity, that's even better.
And partial grants, maybe. There's a lot of pieces to the puzzle.
Yes.
But you started a conversation. I think this is really important for the people that we're meeting or whoever's out there. They're like, well, I'm talking to investors. If the investors aren't asking you way harder questions than we just talked about, they're not really interested.
Yeah.
I always gauge interest of the investors looking at our deals by how deep the questions go, because that means they've taken it seriously, they've done their research, and they really want answers. Some of the people that go, oh, it sounds really good, let me think about it, send me a deck, they're not interested.
Yeah. I had a dinner with
you didn't invite me.
Nah, with a potential investor. This was a little bit ago. With a potential investor, and my wife was with me, and we were having a nice dinner, and then we got into the topic, and hard questions were asked. And we had a lovely dinner and wrapped it up, and everyone realized that it wasn't a good fit. But my wife was like, she said she was sweating on my behalf just from the conversation. Like, it should be a somewhat uncomfortable conversation because money will wreck a relationship.
Absolutely.
It will wreck a marriage. It will wreck a lot of things. So that is the only reason we bring it up, is it seems like it's coming up more and more. I literally got a phone call from someone who's not a customer and is not an incubator member. It was a phone call that I took. They were looking at building a vehicle. They wanted to build one vehicle for themselves and then maybe turn it into a product. And we had a whole conversation about how that would look and yada, yada. And he said to me, I think if we can just get the design nailed down, then I can go out and try to raise money. The chasm that exists between design and revenue is huge. And that was one of the big things that spurred this in me after I took that phone call. And then we had quite a few meetings where people brought up raising money with no clear understanding of what their UVP is, who their market is, what their go-to-market strategy is, because how could you go to market when you don't know what your market is? No clear understanding of their UVP, no clear understanding of what they
cost structure,
what they would use the money
produced.
for.
Yeah.
It's
I
just
do think
wild.
we have to wrap though, but I do think we should do a whole episode, and you can DM me if this is a good idea. We should do a whole episode on what to expect if you're talking to investors.
Yeah.
Because people don't understand the level that an investor wants to get into your business, and that you have to prove to them that you're an expert.
Yeah.
In your business, not in anything else. If you don't know how your business works, they're not giving you money.
And in that same vein, and this is the last thing I'll say, then we'll wrap it up. The same way that a lot of people talk about grants and don't think about the fact that grants are expensive to manage. If you are a single owner operator going after a grant, you will need a different infrastructure most likely to manage that grant. It will cost you money, and it may or may not even be worth taking the grant out. It may be worth it. It may not be worth it. Depends on your business model. The same way, taking on investors takes time and effort away from you doing the other thing. You will be on the phone with them. You will be issuing reports. You will partake in an agreement that says what you owe them and at what time frame to keep them in the loop, if that's their role, depending on what their equity agreement is. So there is a cost to that. That is, you are not working on product. You are not working on distribution. You are not working on sales. You are working on investor relations. Just like with a grant, you are working on grant management, or you have a team that you now employ to do grant management.
Which eats into the grant.
Yep.
Okay.
It comes out of the grant, for sure.
All right. Till next time.
So that's it. All right.
See you, Bob.
DM Bob if you got questions.